Hello, my dear aspirants. Welcome to Clarity for Show. Today, we are going to discuss a very big announcement that RBI has recently done with respect to its interest rate revision. Right. So, we will discuss today, and I hope that everyone is seeing this image, the image which is there on my screen. So, in this image only, we will try to understand each and everything with respect to MPC, with respect to the decisions that MPC has taken with for repo rate revision as well as CRR revision. All right. And under what circumstances this rate revision has been taken and what are the impacts that this rate revision is going to have over the economy at large, and what would be the target of RBI that it is setting for the coming for this fiscal year, financial year 26. All right. So each and everything we will try to understand through this image. If you want to take a screenshot of this image, then you can take this screenshot. All right. Now, coming to the first point, let's try to understand each and everything in a proper sequence. All right. So, as you can see, RBI Monetary Policy Committee. So, this Monetary Policy Committee, the purpose behind the commissioning of Monetary Policy Committee is to manage the interest rate in our economy, to bring to fix the interest rate, or you can say policy rate for the banks. All right, with proper transparency. Therefore, MPC has been formed by through this section 45 JB of RBI Act of 1934 in the year of 2016. All right. So MPC has been formed in the year 2016. I hope that 27th June was the date. Okay. By amending sections 45 ZB of Reserve Bank of India Act 1934, amending the Finance Act of 2016. Finance Act of 2016. This was this actually amended this RBI Act of 1934 in order to include in order to constitute Monetary Policy Committee, whose prior responsibility is to decide the policy rate of our central government. All right. So I hope you must have understood about this. Now, tell me in comment section that under which MPC, under which meeting, whether it is 50th meeting, 52nd meeting, 53rd meeting, 54th meeting, or 55th meeting, under which meeting of this RBI MPC, this rate revision, this massive rate revision has been held, which took place in the between 4 to 6th of June 2025. Now you need to answer me in the comment section that what is the number of that meeting, that is 58th, 52nd, 53rd, 54th, or 55th, under which meeting. And in that comment only you need to answer me that who headed this meeting, who headed this meeting. All right, this MPC meeting is headed by whom? Now I'm talking about the MPC. Then you can see it constitutes 6 members. Okay, 3 from RBI, and 3 members are appointed by the central government. 3 members are from RBI and 3 members are appointed by the central government. All right, this is all about the Monetary Policy Committee. Now, let's talk about the rate revision, the decision that MPC had took on 6th of June. Let's talk about that. Now, see here, as you can see, have you heard about the concept of Liquidity Adjustment Facility, LAF? Many of you must have heard about this concept, LAF, Liquidity Adjustment Facility, LAF. All right. So under this, you have 3 routes. Like the first one is SDF, Standing Deposit Facility. Then we have repo rate, or the interest rate, you can say repo rate. And then we have marginal standing facility. So it has 3 broader pillars, you can say, right? The SDF, which is generally 0.25% or 25 basis point less than repo rate. All right. If the repo rate is 5.5%, then the standing deposit facility would be 5.25%, and marginal standing facility is 0.25% or 25 basis point more than repo rate. That is, it must be around 5.75%. Now, you must have understood that was the difference. So 0.25% less or 25 basis point less and 0.25 basis point more for this MSF. Then you must be aware about the repo rate. This is the rate. Let's talk about repo rate first. This is the rate at which the banks used to borrow from RBI. Okay, with an agreement to repurchase the collateral that it puts in the form of security, right? So bank has to put some sort of collateral with RBI, and in return of that, bank actually get rupee from, or you can say loan from RBI at the interest rate which is there. Right now it is 5.5% after the rate revision. Okay, at this percent bank is getting interest rate with an repurchase agreement that it is going to repurchase its security, its collateral, after a certain time. All right. So this is policy rate or the repo rate. Now talking about the SDF, what is this SDF? This is standing deposit facility. Standing deposit facility. So this SDF is like, if bank have certain amount of money that idle, it is kept idle in the bank. So if bank has excess money held with bank, it can keep those money with RBI, and for that RBI is going to pay some sort of interest rate. So it must pay 25 basis point less interest rate than the policy rate or the repo rate. Okay, so bank has excess money, it is keeping with RBI, and it is getting interest rate over those money at 25% less than the policy rate. This is standing deposit facility. Standing money. The money is standing in the bank, it is kept idle. Therefore, the bank used to keep those money with the RBI. Now, marginal standing facility. So this is the facility available with the banks, where banks can borrow money from the RBI. Okay, for short term, in order to meet the short term requirements. So if bank is borrowing money from the RBI, therefore RBI charges the interest rate over the borrowed money at 25 basis point more than policy rate. So it must be 25% more than the policy rate. All right. So currently it is 5.75%. So marginal standing facility, through MSF facility, banks can borrow additional money from the RBI in order to meet their short-term requirements. All right. So this is all about the liquidity adjustment facility. This you need to remember: the SDF, the floor level, then the repo rate, then the ceiling rate. We call it ceiling rate. Above it, there is no rate, and this is a floor rate. Floor rate, the lowest rate. Okay. And for SDF, no collateral is required. No collateral is required. All right. No collateral is required. Now, let's move on to this image. Now, let's try to understand through this image that what exactly happened in this MPC meet, which held between 4 to 6th of June. MPC generally meets bi-monthly. Every 2 months it used to meet, and from last 2 times MPC is revising its policy rate. So you might be aware that in the month of May it revised its policy rate by 25 basis point. It lowered actually its policy rate by 25 basis point. Earlier it was 6.5%. In Feb it was made 6.25%. Then again in the month of April, RBI MPC revised the policy. It reduced the policy by 25 basis point, and from 6.25% it further make it down by 6%. And in the month of June, we have seen a major shift of 50 basis point reduction, and we have seen from 6% it was reduced to 5.5%. So we call it a accommodative stance, not accommodative stance, a neutral stance. So if this is being there in the newspaper that RBI shifted its stances from accommodative to neutral, then you must be aware about this term. That what do you understand by accommodative stance and what do you understand by neutral stance? Okay, so accommodative stance is the stance where RBI usually, or MPC you can say, usually lowers the interest rate or policy rate in order to infuse money into the banking system. In order to, the purpose behind the accommodative stance is to lower the policy rate in order to infuse money into the banking system. This is the purpose of accommodative. Now coming to the neutral stance. So neutral stance here, RBI use in neutral stance, RBI follows the flexibility um, ability with respect to its policy rate. Flexibility means either it will increase the policy rate, or it will decrease the policy rate based upon the macroeconomic conditions. Try to understand, neutral stance is based upon the macroeconomic conditions or circumstances, you can see. So currently, if RBI has reduced its policy rate by 50 basis points, then it must be affected due to the macroeconomic conditions, which can be the global economic uncertainty, market liquidity, all right, and obviously the budget projection this year, which actually talks about the stimulation of growth. So keeping in mind these macroeconomic conditions, RBI has revised its policy rate by 50 basis points. They actually reduced the policy rate by 50 basis points, and right now the policy rate is 5.5%. So if it is 5.5%, then 25 basis point lesser would be SDF minus 25 basis point, and 25 basis point more would be your marginal standing facility and the bank rate. Therefore, it is somewhere 5.75%. Am I clear? Am I clear with all of this? All right. Now, coming to the next point. So these were the targets that is stimulating the growth. Under these are the macroeconomic conditions which actually provoke the RBI to took such decisions of revising the policy rate. Growth stimulation, there's a target in our budget, decided in our budget this year. The inflation is continuously declining, and we can see the CPI inflation is declining continuously, and it reached somewhere close to what we have seen in the month of April 2019. Okay, so CPI inflation get down to there. The projection of CPI for this year was 4%, but we can see the CPI inflation is being projected for 3.7%. All right. Earlier, the projection was 4%. So continuously, the inflation is declining, and there are several factors like we have a good monsoon this year, and bumper Rabi crop harvesting we have seen this year. Rabi harvest is good this year. All right. We have seen that the gold price actually it is softening right now. It is softening. So these are the reasons. Therefore, and obviously the crude oil price actually it also softens, right? In this Ukraine Russia war crisis as well as the Middle East crisis. Then we have seen the market liquidity. This is the target of RBI, that the liquidity into the market is to be enhanced. Therefore, also it actually reduces the policy rate so that the liquidity inflow into the market will increase. See the impact here. You can see when we lowers the repo rate, it means banks can avail the loans from the RBI at cheaper rate. Banks can avail the loan from whom? From RBI at cheaper rate. Means banks can provide the loan facility to its borrower, whether it is individual or the businesses, at low interest rate. When the borrowing cost for bank is less, then obviously the lending cost for bank the interest rate over the lending would be less, right? Means borrowers somewhere they are benefiting. It means borrowers are encouraged to borrow more money for the market from the market, either for their self consumption or for the expansion of the business. Hence, it is going to increase the borrowing, and obviously it is going to increase the spending in the market. Means investment in the market will increase. Means liquidity into the market will increase. Either borrower would diversify the investment, means the savings in the market will reduce, and they will diversify their estate investment into the stocks, mutual funds, all right, REITs, real estate, okay, in bits. So they are diversifying their investment by reducing the savings, because they are getting the loan at lower interest rate from the banks. All right. So this is the impact. Therefore, overall, the liquidity into the market, means money circulation into the market, actually going to increase when RBI revises, when RBI lowers down its policy rate. All right. So and opposite to that, when RBI hikes the interest rate, then the loans for the banks from the RBI become costlier. Means it is going to charge high interest rate from its consumers, whether it is individual or the businesses, and obviously it is going to bring slowdown into the market. Means borrowing would be slower. Obviously, the spending or the investment would be slower. It will reduce. All right. Means liquidity would reduce in case of hiring of interest rate or the repo rate. All right. So this is all about. Now, see here the impact that we talked about, that it will stimulate the economic growth. This decision will stimulate the economic growth. It will strengthen the financial markets. It is going to strengthen because people are diversifying their investment into the stocks, in bonds, right? REITs, real estate, infrastructure investments, mutual fund investments. So it will strengthen the financial market, and obviously it will make the export more competitive. It will make export more cheaper. People will be motivated to export more. It is going to make the export more competitive, right? So these are the impact, the immediate impact that we can see after this rate revision. All right. And see here the projection of RBI, CPI inflation. RBI has projected 4%, but now RBI has reduced it by 30 basis point, and it has projected the CPI inflation for the financial year 26 would be 3.7%. All right, would be 3.7%, and the real GDP growth for FY26 would be 6.5%. It remained unchanged actually, right? So these are the things that are under this decision that RBI has taken place, that MPC had decided from 6 on this 6 June MPC meet. All right. In the comment section, you have to answer me few questions. The first question that I have asked, that you have to tell me that this MPC is of which number meeting. Okay, you have to tell me the meeting number, whether it is 50th, 52nd, 53rd, 54th, or 55th. You need to answer me into comment section. The second question, who headed this MPC meet that took place between 4th to 6th of June 2025? All right, who headed this meet? Then you have to answer me that CRR also got revised in this meet, and we have seen that CRR actually revised, and we have seen that by 100 basis point, CRR has been reduced. From earlier it was 4%, now it is 3%. Okay, and this will came effect of in different tranches, and you have to answer me that from which month it is going to implement. From which month this reduction in CRR is going to be effective. All right, from which month? it is going to be effective. And if CRR will decrease, question number 4, if CRR will decrease, then what would be the impact over the liquidity into the market? Whether the liquidity into the market will increase, decrease, or remain neutral. So you need to answer me these 4 questions in the comment section. That's all for today, my dear students, my dear aspirants. Thank you very much. Have a nice day. Bye bye. Take care. See you soon.